Hello and welcome back to our IFRS 18 series. Today we will be discussing exceptions to the general classification rules in the Statement of Financial Performance under IFRS 18. In the previous video, we explored the new Statement of Profit or Loss and what income and expenses are included in the 5 categories mentioned in the standard: the operating, investing, financing, income taxes, and discontinued operations category. In video number 2, we will be discussing exceptions to the general classification rules, because as with many accounting standards, there are exceptions in IFRS 18. IFRS 18 recognizes that not all companies operate in the same way. It provides some flexibility for those with unique business models. In this video, we'll delve into those exceptions and see how IFRS 18 handles these special cases. As we discussed, the operating category is the heart of the company's activities. It is where they record the company's income and expenses coming from day-to-day operations, and those income and expenses that do not belong to the investing and financing category, since the operating category becomes a residual definition. But for some companies, their day-to-day operations might involve activities that would normally fall under the investing and financing category under the general requirements. This is where the exceptions come in. Basically, it explains which income and expenses that fall under investing and the financing category, for example, interest expense, fair value gains and losses, rental income, dividend income, which of these that normally fall under the other categories under the general requirements would have to be transferred to the operating category if the company that you're doing accounting for falls under or is operating under the specified main business activities, specifically identified by IFRS 18. So, what are these specified main business activities that I am talking about? IFRS 18 defines 2 types: companies investing in assets and companies providing financing to customers. Let's look at each one. IFRS 18 provides specific examples of companies that might fall into these categories. For example, companies investing in assets, think of investment entities under IFRS 10. Real estate companies, or those companies that invest in real estate for rental, for capital appreciation, and even insurers. On the other side, for companies providing financing to customers, we have banks, lending institutions, and companies offering finance leases. The idea is that if the business model of the company falls into one or both of these specified main business activities, then the exceptions apply. However, we apply the exceptions only to certain income and expenses. That's why we have to do this discussion. Not all of the profit and loss of that specific company goes into the operating activity. We have certain rules to follow. And you might also notice that the 2 main business activities that specifically identified by IFRS 18 are those companies that have day-to-day operations that belong to the investing category and the financing category. IFRS 18 says that you do not have to assess all the other types of business models. So yeah, we will discuss both of these one by one. So we will start with those entities whose main business activities is investing in assets. Before we dive into the specifics, let's first discuss the general requirements for classifying income and expenses in the investing category, because the main business activity of investing in assets exception is actually an exception to the investing category income and expenses. So it's better to have a recap of those, even though we have already discussed them in the first video. So basically, we have 3 different types of assets that whose income and expenses go into the investing category under the general requirements. We have 3 types: investments in associates, joint venture, and unconsolidated subsidiaries; other assets who generates individual returns for the company, or who generates returns that are independent of the other assets of the company; and cash and cash equivalents. However, even though there are 3 types of assets, you have to remember that under IFRS 18, you only have to assess whether the company investing in the first 2 types of assets. The cash and cash equivalents is a special case, The standard is saying that if the company is investing in financial assets as part of the second one, as part of the quote unquote other assets, if the company is investing in financial assets as a main business activity, then the cash and cash equivalents or the income and expenses from the cash and cash equivalents have a special treatment in the statement of financial performance or in the statement of profit or loss. So for all of these three types of assets, the income and expenses, in particular, the income generated by these assets, the income that arise from the initial and subsequent measurement of the asset, and the directly attributable costs from the acquisition and disposal of these three types of assets, they go into the investing category under the general requirements. All other types of income and expenses, if any, would go into the operating category because IFRS 18 specifically already is telling you that only these three types of income and expenses from these three types of assets go into the investing category. So it's very specific or very prescriptive. However, what about if it falls under the exception? It falls under the exception if the company is investing in, if the business model of the company is actually investing in investment in associates, joint ventures, or unconsolidated subsidiaries, for example, investment entities, or they invest in other assets that generate individual returns, for example, financial assets, or the business model is actually investing in real estate properties, for example. So now we have to assess the P&L, the profit or loss of that entity under the exceptions. So what are these exceptions? The exceptions are different depending on the different type of asset. So first, the investment in associate, joint ventures, and unconsolidated subsidiaries. If that investment is accounted for using the equity method, the income and expenses of that asset, of that investment in associate, joint venture, because you have options under IAS 28, right? If you still chose equity method for these types of investments, then it would still be the investing category. You will notice that there is actually no change in the general requirement and in the exception. However, if the investment is not accounted for using the equity method, meaning it's a residual definition, no matter what accounting basis you're using, maybe the cost, the most normal would be the fair value model, you would have to put everything, all of these income and expenses, into the operating category. So you see, if it's equity method, it's always investing category. How about for other assets that generate individual returns? It becomes operating category. No other questions asked. There's no other sub analysis that you have to do. The other assets, for example, rental income, in a normal company that doesn't invest in real estate, and they, for some reasons, they have investment property that they generate rental income from, it would normally be in the investing category. But if that company is a real estate company that you have assessed to be investing in real estate assets, then all of those rental income, all of these three types of assets, because the rental income is an income generated by that asset, it would now go into the operating category. Now, for the cash, so there are three types of things that you have to remember, but I will first discuss the first two. If the company is investing in financial assets, this is what I told you before, then the income and expenses of that cash and cash equivalent go into the operating category. But if the company is not investing in financial assets, then it would still be in the investing category. So it really depends whether you are investing in the second type of assets, and if that asset is actually a financial asset. If it's not a financial asset, then your cash would still be under the investing category, the income and expenses from the cash. However, there is a special exception for cash and cash equivalents. If even though you are not investing in financial assets, but you are providing financing to customers, meaning it is the second type of business model. If you are doing it like that, then your cash and cash equivalents have more more exceptions that we will be discussing a little bit later. We will now move into the financing category. So as what I've mentioned before, the financing category is the main basis of the exception for those companies that are providing financing to customers. Because as a general idea, if even for a normal company, some activities are actually financing category income and expenses. However, what if your business model is actually giving financing? So it means that certain income and expenses actually deserve to be put into the operating category, and this is what we're going to be discussing. Under IFRS 18, they're actually specifying which income and expenses go into the financing category, and that is coming from two types of liabilities. So they split the different liabilities of a company into two types. The first type are liabilities coming solely from the raising of finance. For example, it is solely a bank loan or these types of transactions wherein you're really getting money from lenders. For example, there are other examples under the standard, but this would be the most common. And other types of liabilities, because under IFRS, if you apply other IFRS standards, you can generate different types of liabilities that are specifically or strictly not for the raising of finance. For example, these liabilities or liabilities under share-based payments. Um, so these types of liabilities, there are different income and expenses coming from them. And then you have to classify these income and expenses into either financing category or operating category, depending on the type. For example, for type 1, the type 1 liabilities, you have to classify the initial and subsequent recognition income and expenses related to this type 1 liability and any incremental income and expenses arising from its issue and extinguishment. All of these are classified as financing category income and expenses. And then we have type 2 liabilities. All other types of liabilities, however, you have to split them because there are some income and expenses from type 2 liabilities that go into the operating category, because the IFRS standards only mentions that the financing category income and expenses should include only those arising from interest, income, and expenses from the application of other IFRS standards. For example, for these liabilities, you will have an interest expense. However, it is a type 2 liability coming from the application of IFRS 16. That's why here you will have to put it in the financing category. And other interest, other changes in value of the liability coming from changes in interest rates. For example, if you're doing fair value accounting and the fair value would depend on changes in interest rates, a portion of that fair value would have to be in the financing category, which makes it a little bit more complicated, but it is how it is. And the standard specifically specifies that from income and expenses from other types of changes other than these two would fall under the operating category for type 2 liabilities. So type 2 liabilities become a bit more complicated because now you have to because there are other income and expenses that could be classified into the operating category, so you have to be careful. For type 1 liabilities, practically everything from the type 1 liabilities from initial inception up to the extinguishment or disposal would go into the financing category. So what are the different exceptions that we have? These exceptions apply if the company is actually providing financing to customers. However, if the company is providing financing to customers, it's still important for you to identify which are the type 1 liabilities and which are the type 2 liabilities, because there are special treatments for type 1 liabilities. Because normally it's the type 1 liabilities that are used for providing financing to customers. So the exception is that for type 1 liabilities, if the type 1 liability relates to providing financing to customer, then that liability, the income and expenses, all of this from that liability go into the operating category. If the type 1 liability does not relate to providing financing to customers, for example, you generated it independent of the fact that you're going to release it to you're going to release the funds to the customers, for example, they're not economically linked, the liability and the receivable from the customers, then you have an option to classify those income and expenses into financing or operating. Remember, the IFRS 18 is not telling you where to put it. You have an accounting policy option of financing or operating. Again, if this is a liability, type 1 liability that does not relate to providing financing to customers. However, the standard is saying that okay, it could be a bit more complicated if you cannot distinguish if the liability is related to providing financing to customers, your main business model, then um, you still have an option to put it either financing or operating. So it's an accounting policy option. For type 2 liabilities, again, it is much easier. All of the income and expenses previously put in the general requirement as financing is still under the financing category, because the standard is recognizing that normally type 2 liabilities are not related to providing financing to customers. And all the other income and expenses like before are both under the operating category, both in the general requirement and in the exception. You will see that for type 1, the exception only applies for type 1 liabilities. And it's not even a very exact position. If the liability does not relate to providing financing to customers, you still have an accounting policy choice. But we'll be discussing what is the impact of this accounting policy choice on the other parts of the financial statements that you have. And now, what what about this cash and cash equivalents? Because I said before that um, even if you're not investing in assets, but if you are under the exception of providing financing to customers, your cash and cash equivalents could be part of that activity of providing financing to customers. So, for cash and cash equivalents, all the income and expenses specified in the slide before, in the general requirements, as what I mentioned, they belong to the investing category. But if your company belongs to the exception of providing financing to customers, you have to assess if the cash and the cash equivalents relate to the business of providing financing to customers. You have to put the income and expenses in the operating category. If the company assesses that the cash and cash equivalents are not related to providing financing to customers, then you still have an accounting policy choice of putting it in investing or operating. Remember, it is not an accounting policy choice of financing or operating. The cash and cash equivalents would always go to investing, either investing or operating, even though they fall under a different exception. Or if you cannot distinguish it just like before, you also have an accounting policy choice of investing or operating. You will see that the type 1 liability exceptions actually mirror the ones for the cash and cash equivalents. So it's just for you to easily remember things. We will talk about more examples later for practical applications. And the standard is saying that these two exceptions here, if the company provides financing to customers and the cash is not related to the service, and if the type 1 liability does not relate to the business of providing financing to customers, these two options that you have should be aligned. If you choose here operating, your cash should also be operating. If you choose here financing, your cash should be in the investing activity or investing category. And there is also another special thing to remember. If you are going to choose here financing or operating, so it means, so just to have a recap, if you fall under the exception of a type 1 liability and you have other liabilities that do not relate to providing financing to customers, because you have to separate them. What are the liabilities related to providing financing to customers, and what are the liabilities that are not related to financing to customers? You have the option of putting the income and expenses into financing or operating. So you have to be careful, because if you chose financing here, then you have no problem. All the previous discussions are still applicable. However, if you choose operating, you see there's another slide. If you choose here the operating category, then remember in the first video we discussed about the new subtotal of profit before financing and income taxes. This is now an example of a financing of a company under that exception who chose the operating category. You are not allowed to present this subtotal of profit before financing and income taxes. It's not an accounting option. You are not allowed, because it will be misleading to the users of financial statements, because you cannot say that this is the profit before financing and income taxes when you actually have a lot of financing, income, and expenses in your operating category, because you chose that option of putting in the operating category even those income and expenses that are not related to financing to customers, right? So yeah, that is just the only thing that you have to remember on these options right here. So if you choose here operating, you're not allowed to have the second new subtotal. You have to just present the operating profit. So now we're going to talk about the different examples under the illustrative examples of IFRS 18 on what are the different formats that you are expected to see. So this is not very prescriptive, so there are different assumptions that the IFRS 18 is using, but it's a really good basis for examples in case you're going to apply it in the future. So illustrative example number one. So this is the type of income and expenses or statement of profit or loss for company applying the general requirement. The assumption that we're using is that the company is a manufacturer that is neither investing in assets nor providing financing to customers. So we're presenting the expenses by nature and not by function because it represents the useful structured summary of the expenses. So you're seeing here that we have the two new types of subtotals, the operating profit and profit before financing and income taxes. The profit before financing and income taxes includes the operating profit plus the investing category income and expenses. And then we have profit before income taxes, which includes now all of the operating, investing, and financing category income and expenses. And then we have the income tax expense. We didn't present here the standard didn't present here the um, profit from discontinued operations, but it would be on the lower part of the presentation of the profit or loss. So this is the general requirement. So the second illustrative example that I wanted to show you are companies providing financing to customers. The assumption that we used here is that the company is a manufacturer. Although he is a manufacturer, they also provide financing to customers as a main business activity. Could be possible because they're selling their assets or their inventory on a staggered payment basis to the customers on an extended payment term. So that is a form of providing financing to customers even though you're not a bank. So here we see that they actually selected the first option. You remember if it's a type 1 liability, you have to assess whether the liability is related to providing financing to customers. If the liability is related to providing financing to customers, then your income and expenses on that liability, you have an option of whether you put it in the financing category or operating category. So here they selected the financing category, which means that the two new subtotals should be present in the income statement. You see here, profit before financing and income taxes, because all of the all of the other type 1 liabilities, if they are not related to providing financing to customers, they're put here. That's why it's still safe to use it. So that's the only thing that I wanted to show you here. But also, the interest revenue and interest expenses related to providing financing to customers are in the operating category. You see, they have subtotal of net interest income because it shows that part of the business of operations of the company that is related to providing financing to customers. So this is one of the more interesting parts of this income statement. You can pause the video if you want to examine the income statement on the screen. So illustrative example number 3 are types of companies that are investing in assets. For in this example, it's an insurer that invests in financial assets and does not provide financing to customers. So it's purely financial asset. It means that the income and expenses from cash and cash equivalents should also be in the operating category, right? So here you just see that the investment income is in the operating category instead of in the section of the investing category. So before the profit before financing and income taxes. So you see here the share of profit or loss of associates or joint ventures 5.4 thousand. This is assuming that we are using the equity method because under the equity method it's always investing activity, as what you remember from the previous discussion. And illustrative example number four. So here it's both investing in assets and providing financing to customers. So here, this is actually the same example that I presented before, wherein there's no second subtotal because they chose the operating category for the income and expenses for type 1 liabilities that are not related to providing financing to customers. I know it's a mouthful, I know it's a lot to remember, but you just have to like follow those the things that I gave you so that it's easier to digest them. So in probably in the next videos, we will be discussing more practical examples, or like for example how to assess what are the standards saying on how to assess a company whether it is investing in asset or providing financing to customers. So because there are some sort of different other discussions regarding those topics, but because right now we have just discussed to you the different rules that you have to follow and you have to apply them in your specific case. And thank you. That's all for this video number 2. See you in the next one.